My real long-term goal is just to keep that fire burning as long as possible and keep playing the game, ideally for the rest of my life.
What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm actually interviewing a friend and business partner of mine, Sean LeBlanc, who is the founder of Mammoth Properties, which is a vertically integrated multifamily real estate company in Southern New Hampshire. So he's a fellow New Hampshire investor. He's somebody I've done a handful of deals with in the last couple of years, all of which are going extremely well, far exceeding projections. And I wanted to have Sean on the podcast because he's one of the best operators I know. Him and his team are excellent operators, especially as it relates to executing value-add business plans, C and B class value-add business plans, which is what we do in our business, in the Aligned Real Estate Partners business. We're very familiar with these types of deals. And Sean and his team are great at them. He's a very hands-on operator. He really defines this as his special sauce and where he brings a lot of value to the deals that he actually does, and also to the partnerships that he structures with other investors, me being one of them. And in this episode, we get into his story as well and how he started his business, how he began scaling his business. Sean's got a background as a mortgage broker. He worked as a mortgage broker for 8 years. And while he was working as a mortgage broker, he became interested in multifamily real estate and rental real estate, and eventually left his job as a mortgage broker to pursue growing a portfolio, a buy and hold portfolio. And I think his story is interesting because he made, it wasn't necessarily incremental steps as he was growing, but more, big leaps as it relates to the types of deals that he was doing. We talk about how he went from a duplex to a 7-unit and then to an 8-unit. And then he bought a 30-unit portfolio shortly after that, began raising money, began hiring internally to grow out his management platform, his management company. And just a very relatable story, very inspirational story, and one that I think a lot of the listeners are going to take numerous things away from, both tactically speaking, and then also just from a motivational standpoint. And something else that I want to mention here as well, because I'm going to be talking about it on the podcast next couple of episodes. Sean and I are actually working on a deal right now that we're about to start raising capital on. And depending on when you listen to this, we may already have started the capital raise process. And if so, you should go down to the show notes and book a call with me, or go actually look at the deal room for the deal itself. May not be built out by the time this goes live, but you go check it out anyways. We are buying a 72 units Class B multifamily asset in the seacoast of New Hampshire in a town called Barrington. This is a deal that I actually sourced direct to seller. This came from a mailer. I've been sending this owner mail for a number of years, owned by 2 individual owners, long-term owners who have taken great care of the property. And we are really excited to buy this deal and to shepherd it into the next generation. Very compelling investment opportunity, something that we're extremely excited about. It's going to be a 506c syndication, so accredited investors only. If this is something that you are interested in learning more about, again, go check out the show notes. We're going to have links to materials down in the show notes. And if you'd like to learn more about it, obviously book a call with me. We'll chat about the deal itself. But again, listen to this episode because Sean and I are buying it. He's a great operator. He's going to be executing on the ground on a day-to-day basis with this deal. And I'm extremely excited to pursue it with him and also to share his story to the podcast listeners. Now, with that being said as well, if you like this episode, if you enjoy this episode, please consider leaving the podcast a rating and review, as it helps the show get noticed by more folks. But again, thank you all for listening, and I'll catch you guys on the next episode. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is Mr. Sean LeBlanc, who is a friend of mine, a business partner of mine at this point. We got a few deals together, as I probably mentioned in the intro, and a fellow New Hampshire investor, which is a small subset of the guests that have been on this podcast, frankly. Not a lot of New Hampshire folks, despite the fact that that's the predominant percentage of my network of people doing deals in New Hampshire. But it's great to chat with somebody else through this medium who's also doing deals in New Hampshire, because it's, I'm getting something out of it as well. So, Sean, why don't we start with your background, share a little bit more about where you came from, what you were doing maybe pre-real estate, and then how you got into the business today.
Absolutely, Axel. Well, it's great to be here with you. First of all, I'm a big fan of the show and a longtime listener, so it's really an honor to be here, and I appreciate it. Happy to jump into some background and give you a little bit of info on how I got started. Try to be a little bit brief with this and not go on forever, but I grew up in Connecticut. I went to college in New Hampshire. I graduated in 2012 with a fairly useless state school degree and really, no idea what I wanted to do with my life, honestly. So
Keene State, right?
Exactly. Keene State, go Owls. So, I kind of was hit in the face by life at that point of graduation. I was an athlete early in my career. The first 20 or so years of my life was just focused on athletics. And then things changed when I graduated college. So I jumped into a sales job immediately. I kind of thought that would be the career for me. I was motivated by unlimited income, pay by performance, things like that. My dad sold copiers and printers growing up. So I just kind of thought that was where I was going to make my living. I found myself within a matter of months pretty miserable in that sales job and entered into kind of a quarter life crisis, I would say, where I started diving deep into personal development books, business books, really looking for an identity. Um, and in that process, I stumbled across the Purple Bible, Rich Dad Poor Dad, Robert Kiyosaki, which had a profound effect on me, like it has for so many others. And that just kind of pushed me towards real estate. And from that point forward, I just started voraciously consuming everything I get my hands on in terms of real estate. Any kind of content regarding real estate investing, I was consuming. So every book that's out there, I've read. I was listening to the podcasts from the moment I woke up until the moment I went to sleep. I was listening to something real estate related, and I essentially became obsessed with the idea of becoming a real estate investor. The problem was I was, completely broke. I was living with my girlfriend's parents. I had no credit. I had no, options to get a loan from family or anything like that. So I made a decision at that point that I needed to just put my head down, make some money, and then I'll try my hand at investing later on. So I ended up jumping into a job in the mortgage business. I figured that was, kind of real estate adjacent. And that job gave me a huge financial education. It taught me about interest rates, bond markets, the economy in general, real estate finance, obviously, all things that I really wasn't privy to before. And the more I learned about that stuff, the more it solidified in my head that, owning these cash flow producing assets was really what I wanted to do. It took me some time to get some momentum in my mortgage business. Wasn't until 2016 I went out and finally took some action and bought my first deal, which is kind of a unique one. It was a duplex with some seller financing included. The short story on that one is I got lucky and was able to subdivide the land, create two additional lots from that one parcel. I sold those two lots to a builder. That was kind of my springboard. When rolled that money into a 7-unit property, fixed it up, refinanced, bought an 8-unit property, all while working my mortgage job. And then somewhere around 30 units or so, I just couldn't straddle the line anymore. I couldn't be half in, half out. And I just let my mortgage license expire, stepped away January of 2021 to go full time in real estate with the plans of, really growing a large portfolio. And it's been a little slower than I thought it would be. We ran into a tough market in 21, 22, just kind of hard to get a deal done. But the growth has been steady. And now, fast forward to where we are today, a little snapshot of this point in time is I own Mammoth Property Group. It's a vertically integrated real estate investment firm. We're based in New Hampshire. We're focused on multifamily in the New Hampshire and Southern Maine markets. And we manage everything in-house with my small team. So that's where we are now.
Love it. No, I mean, it's I can relate to a lot of that story as it relates to just becoming, the bug kind of being planted there and just becoming obsessed with how do you buy the first one? How do you scale? How do you raise the money? How do you put it together? How do you manage all of that stuff? Right. I think it's a little addicting when you start consume content there, whether it's podcasts or what have you. And starting from a place of not being too financeable is one that I most definitely relate to, because I think we both got into this at a younger age relative to, I guess, when most people get into real estate investing, just generally speaking. And having a commissioned gig or a 1099 gig or being a business owner, whatever it is, makes it so much harder to get those first couple done, just because you don't have that nice, pretty W-2. So I think it's interesting, and it's almost nice because you learn the business at altitude in a way where you're almost forced to get creative from the start. And then that sets you up for a little bit more of a scalable foundation because you know how to do all of that stuff. But first deal, duplex, sold off a couple lots. Then you just jumped right into 7 units. I think there's some people listening to this that, that feels like that's a bigger jump. I mean, for me, for example, I just went 2-unit, 3-unit, 4-unit, back to 2 units. And it was just a lot of these smaller deals. But it seems as if, you had less of kind of a linear growth, at least initially. And it was a little bit more hockey stick in the sense that you went duplex, 7-unit, then 8-unit. And then just based on my own knowledge of a lot of the deals that you guys did or have done and are in now, continually jumping kind of the unit count and growing from an average deal size in a property size relatively quickly. Was that a conscious decision you made at the time? Was that something that you actually sat down and sketched out and planned out early on when you started buying and started growing the portfolio? Or was it more opportunity kind of presented itself from a deal standpoint? Because I think that's a little bit outside of the ordinary as it relates to how a lot of people kind of organically start growing a buy and hold rental portfolio.
Absolutely. It's a great question. So for me, it was totally intentional. I always aspired to be in larger multifamily deals. And a big reason for that is touching on consuming real estate content and podcasts and books and things of that nature. The common themes, what it seems like with every real estate podcast, as you well know, is when they talk about what they wanted, where they ended up, they always almost end up in larger multifamily. So if it's a podcast about a prolific wholesaler, a prolific house flipper, whatever it may be, well, what are you doing now? Oh, now I focus on larger multifamily deals.
Yeah,
It seems like,
literally.
it's every single podcast. So I took that to heart. I figured, that's ultimately where I want to be, is in those larger assets. I understood very quickly, even with a duplex, I understood very quickly this property was going to make almost no money from a rental standpoint.
Yeah.
So that was kind of a rude awakening. I had my entire savings into this duplex and realizing quickly that there's really going to be no cash flow to speak of. I knew that I wanted to make a jump in terms of a number of units. And it was definitely a conscious decision to try to just always take a step up in unit count when buying these properties, really going out for those economies of scale that everybody talks about with multifamily.
Yeah, I mean, it's the other thing I think that you literally hear from every single podcast guest that's related to multifamily as well is, if you were to start over again, what would you do differently? And it was like, I would have went bigger sooner. I think that's literally everybody's answer to that question on a podcast, which I always laugh at because, I mean, I get it. I would probably say the same thing, but I think the challenge people have is it's really hard to do that in the moment because you don't know what you don't know, because you maybe have some level of nervousness around your skill set and your ability to do a bigger deal. And it's hard to actually listen to that advice and put it into practice because it is pretty nerve-wracking as it relates to jumping in your deal size and whether it's a financial jump in terms of the money you're tying up in it, whether it's you're raising investor money, that creates a whole slew of challenges and stresses behind the scenes too, or even just your ability to actually operate the deal itself. And something I think about with you guys, I mean, you guys are great operators. Obviously, we're collaborating on a handful of deals, and you guys are doing a great job. And that's a real core competency, I think, of you and Mammoth in terms of just the business in general. Was that an early focus? Was that something that you really prioritized early on? Like, did you ever do third party? I've never even asked you this. Do you ever go third party on the management side, or has it been you or your team since day one?
Yeah, so I've never gone third party. I've never had a third party property manager, but I will not say that I very early on built out my management infrastructure, and I knew in the beginning of my career that I was going to have to do that. I self-managed completely by myself up until about 60 units, and that's bookkeeping, leasing, absolutely everything, completely by myself. And what happened there, and I was doing that because I had just stepped away from my career. A, I wanted to have something to keep me busy, and B, I thought, I need to hold on to every possible dollar here. Stepping away from a fairly lucrative career into an investing career. So I was doing everything myself. And what I realized around 60 units is when I had a very pivotal moment in my business where I was going out and I was telling people, I'm going after these large multifamily deals. I'm going to raise money. I'm going to build out a company. And then my day to day, I found myself waking up every morning and putting work boots on because I was going to have to go respond to some emergency maintenance request that I had no business doing, or I was going to have to meet a contractor. And I realized I was out there telling people that I'm going to go buy properties from mom and pop landlords. And I had almost become a mom and pop landlord myself, right? Like it was just me, 60 units, stuff was falling by the wayside, details were getting missed. And I just had a moment where I said, this is not the career that you left your mortgage job for. You're not going to be a solo landlord. You need to make this transition into an operator. And what I did there which was the turning point in my business, is I sold that 7 unit that was my second property I had ever bought. I paid the capital gains tax. I did not roll it into another deal like I desperately wanted to. And I just dumped that money into an operating account. I hired a COO of the management side of my business. He immediately hired two others, and I went from 0 employees to 3 full-time employees essentially overnight, and started running the business completely different and delegating a lot of that management side to my team. And that was when the business took off because I had time to go actually pursue deals on the acquisition side, and I just wasn't bogged down with those management details. So that was the big change for me, and it came out of a point of pain. It wasn't part of the plan. I realized I couldn't do it anymore by myself, and I needed to make a drastic change.
I mean, I think that's usually how it goes. It's usually stuff really starts to break, and then there's a reckoning of, okay, I just spent 30 hours this week on management, and I spent, 6 hours looking for deals and 5 speaking to investors. And you're like, that ratio should be inverted. Like, that's a totally out of whack ratio, assuming that your goal is to continue buying deals and to grow a larger portfolio and to scale, right? Which you obviously defined as your goal early on. And I mean, it's, I hit a similar place. I think a lot of the people that come on the podcast kind of hit a similar place, whether it's 30 units, 60 units, 50 units, whatever the number is. Maybe it's less than that, but it is a similar realization. What I think, though, is interesting is a lot of people tend to go the third party route when they hit that, right? They decide, hey, I don't want to have to be involved in this other than just at an asset management level, managing the property manager themselves, and they go hand it off to third party. And then maybe down the line, they go bring it back in-house, which is exactly the trajectory that we went on in our business. But you just hired internally right away, which I think is probably not the norm on average. It's probably most folks are going the third-party route, and then maybe they bring it in-house later on. But you just brought it in-house right away. Was there a conscious decision being made there? Did you evaluate third-party versus in-house and decide, hey, in-house is the way to go? Like, what was the thought process behind actually doing that? Or were you just like, I know I want to control this, and this is obviously the way that I can continue doing so?
Yeah, great question. So the thought process behind bringing the management in-house was about control, like you mentioned. I just wanted to have full control over the management process, especially because of the type of deals that I was buying, especially at the time. So when we're talking smaller multifamily properties and we're talking value add as the strategy, I feel personally that's very hard to accomplish with third-party management, especially if it's a heavy value add deal. Now you get into the hundreds of units. There's some companies out there who are very well equipped to handle a large value add deal, and third-party can be a great option. On a 7 or an 8 unit deal, when you're going in there and you're turning around the property through renovations, you're changing over a tenant base. That to me is a risky proposition to have your entire business plan hinging on a third party with no skin in the game. For me, I just did not like the idea of trusting what I think is the most important part of the business, the management, the execution of the business plan, to someone who doesn't have a vested interest in the deal. So that was the main thought process. And I knew that I was entering a point where I was going to start bringing in friends and family money, investors, and I just couldn't handle that risk proposition of having a third party in the mix that so much was hinging on. So for me, and then also what I did when I had that pivotal moment and that moment of clarity where I knew I needed to be an operator and not a landlord, is I went out and studied a lot of the best vertically integrated operators in the country. And there's quite a few of them out there. And it seems like the strongest operators, especially in a value add space, all have vertically integrated management. And I think that's for a reason. And so one of the things I've been good at is I always really start with the end in mind. And I knew that was the end goal, was to have a large portfolio with a large, robust management operation wrapped around it. And I just figured, let's take this small portfolio of 60 units, which I had no business having 3 full-time employees at 60 units.
Going to be the next question.
Yeah, exactly. But let's perfect our systems on this small portfolio. This is my first time building a management company as well. And then that way, when we're in the big leagues, we are extremely experienced and our systems are dialed in.
Yeah. I mean, you're absolutely right. I mean, I'm always talking about on this podcast here. It's like, just go look at what all the other people are doing that are 10 steps ahead of you, and just that's the playbook, right? We're not splitting atoms here in real estate. It's a very straightforward business. Like, the innovating that you want to do shouldn't be too significant because frankly, there's not that much to innovate in general, and the playbook's proven. So let's just go model the playbook. And you're right, especially in value add, like there's a lot of massive real estate companies throughout the country, or a lot of real estate investment groups or owners, individual owners, where they use third party, but they're probably buying B plus or A class real estate that's more turnkey, where it's a really commoditized service at that level, and they could drive the pricing down, and there's just not nearly as much on basically at stake from an execution standpoint as there is when you're doing a lot of construction, or you're re-tenanting a property, like a lot of the deals that obviously both you and I are doing and a lot of the folks listening are doing, right? There's just a lot more at stake when there's construction, and the business plan becomes a little bit more complex, which is basically almost all C-class deals at the end of the day. Like most of those types of properties you're buying, there's some kind of a business plan attached to it. And it's important to have vested control over that.
That's a huge distinction. Now, so just to jump in, I don't want to
Yeah.
poo-poo third-party management. I think on a stabilized deal, it's an absolutely great option. But like you mentioned, I mean, we're going in and doing some heavy renovations here on the deals that we buy, and I just want to have my arms around that process.
Yeah. And, as a partner in a third party management company, like obviously I have a different take here and there, but it is a reality in that no, I'm not just disillusioned to the fact that like somebody who is either A, showing up on site, or has a hired employee that is on behalf of the business on a daily basis, like there's going to be a level of service to both the resident and then a level of oversight from a construction standpoint that is hard to replicate with third party. But it's a solution that should be used as a very conscious decision, I think, by an investor, where it's like, I know that maybe I'm going to leave a little bit on the table here by going third party, and I'm okay with that because I really want to scale, buy deals, maybe bring it in-house later when we have more units, et cetera, which was going to lead to the question that I have, which is a lot of the people that bring it in-house, they have a larger portfolio and can hire a significant team right away so that they're not so heavily involved. I think that's the playbook I've seen a lot of other folks kind of implement, where they're at, I don't know, a couple hundred, 250 units, and they can get the leasing agent, the property manager, a couple of maintenance guys, the bookkeeper, whatever. You obviously hired significantly with a smaller unit count, but obviously the portfolio is larger now, 150 or so units, I think you mentioned, right? So it's, how do you balance your time in that business? And when I say that business, I guess I mean the management company, right? The actual components of the business that is leasing units, renovating apartments, et cetera. Balance your time there with balancing your time on the deal finding side, on finding investors, establishing all of the connections you need to actually scale the business from an acquisitions money standpoint. Is there some intentional approach behind that? How do you actually think about that and execute on a daily basis there?
Yeah, absolutely. So it's a juggling act. I see my company as still in startup mode, still in scrappy mode, where it's requirement for every employee, including myself, to wear a lot of hats at this point. It's just a reality of the size of our business and where we are right now, is that I can't afford to have the team that I want to have. I have the team that I can afford, and we need to maximize the operations of that team. So as far as where I spend my time, um, I'm not afraid to be extremely involved in the weeds of the management business. I see that as the secret sauce of my company is my team. They're rock stars. We execute business plans very effectively, and I never want to lose sight of that process. And part of the reason why we're able to push things forward fairly quickly as opposed to other operators is I'm on site. I would say 2-3 days a week. I'm on site at a property, just trying to push business plans forward. Very involved, very much in the weeds. I can tell you delinquency. I can tell you, off the top of my head for the entire portfolio. And for a while, I thought that, I needed to get out of the management. I needed to focus more on acquisitions. I needed to get out there and raise more money. And that was a big reason why I built the team out in the first place. But recently, I've just, realized the value in that management company, and how it's really what I can bring to the table in any kind of partnership situation, is that I have this team and I'm going to push things forward quickly. So I never want to lose sight of that. I see myself as always overseeing the management side of the business, but I have great people on that side of the business that I fully trust. So it's more of managing one as opposed to managing a whole team. And then on the acquisition side, I'm at a flux point in my business right now where I know I need to beef up acquisition activity. I probably need to make a hire on that side of the business in the near future. We're just not there yet. We're just waiting for the portfolio to grow a bit more. And I think that's the plan, is to build up our acquisition side a bit more. But management will always be our special sauce. Construction in-house is something that I always want to continue to bring more and more under our roof. And that's always going to be our focus, is we're going to be known as A-class operators. And that's what I want our reputation to be. The acquisitions and the money raising will always come second for me to the operations.
Yeah, and I think you just said it. You've defined it as your special sauce. And if we think about the three kind of verticals or lanes that you can get really good at within the real estate investing process, right? So you can be unbelievable at acquisitions, you can be really good at raising money, you can be a great operator, right? And a lot of the best investors are good at a couple of those different things. But if you're really, really good at one, you're going to have a place in the business at whole in a particular deal. I mean, like the deal we're working on right now, it's, I've defined myself as the guy who kind of found the deal and has asset management experience. Our third partner's in there helping to raise the money. You guys are going to operate the hell out of it. And if you're really, really good on the operational side, you become a go-to JV partner for a lot of the folks that are in that market anyways, who admit that maybe that is not their strong suit. And maybe they've just decided to really dial in other components of it. Right. And it's funny in our business, you just define like, the money and the deals are going to come second to being best in class operators, which you guys have proven that you are. And then it's funny because I think about it where it's like, we're always going to be really, really good at finding deals. Like that's going to be our special sauce because that's where I invest all, so much of my time and energy on. And we can operate well. We have in-house infrastructure to do so in a lot of our deals, and it's not like we're bad at it. But I'll be the first to say, like, we're making the most of our money because we're buying at the right price, and then we're operating well and just not losing the boat on the way, on the way out of the dock. And you've just flipped it, right? And there's a million ways to generate returns, and it just happens to be becoming excellent at one of those lanes. And if you can be good at a couple of them, I mean, that's huge. Let's go back a little bit because obviously we just dove into the management piece of it, but I'm interested in learning more, I should say, about the trajectory, right? So you went 2, 7, 8 in terms of the deal sizing. Was there a deal that came, maybe it was next, maybe it was soon after those, that you kind of felt as like a jump up, like a step up, and maybe that was defined by it being just larger in dollar amount? Maybe it was raising some money. Does something come to mind, or I should say a deal come to mind that kind of you felt really started to accelerate the business?
Absolutely. Yeah. I would say shortly after I left my mortgage job, sitting around 30 units or so, I obviously was fired up to go get some deals done because I had just walked away from a W-2. So I was able to get a few done. I got 30 units done at once, which was 2 12 units and a 6 unit. And all those closed within a matter of 30 days of each other, pretty quickly after me leaving my job. So that was a pretty much doubling of the portfolio. And another thing that happened there was it was the first time I ever took any kind of outside money. So this was organically, friends and family had kind of noticed what I was doing and had proactively expressed interest in maybe getting involved financially in a deal. So that was the first time ever putting any kind of investor capital at risk. And that's just something I take extremely, extremely seriously. I don't, it's kind of a broken mindset. I don't view it as me giving someone an opportunity to invest and make a great return. I view it as them taking a chance on me and my business and investing in me as an operator. And I take that super seriously. So we got those 30 units done, and I went from 30 to 60 roughly. And that's when, things started to break, like you said. And that's when I have that pivotal moment where everything changed and I brought the management in-house. But that was the first big jump. That was the first time bringing in any kind of outside money, and that was when I started to think about my business as a business as opposed to just being an investor.
What were a couple of the big things you learned in the process of either A, raising the money, or B, kind of structuring the deal? I mean, it's a totally different process, of bosses, as I like to call it. But what were some of the things you look back on and say, well, that was something I learned along the way that kind of stuck out and that I didn't anticipate being a challenge or a learning lesson beforehand?
Absolutely. And I just to get tactical with this mistakes I made on early deals. One of my largest mistakes was undercapitalizing deals and not financing renovation budgets. So even though I have a background in real estate finance, I didn't know what was out there in terms of financing. I didn't do a good enough job of really knowing the market. So all the first deals I did, I wasn't even aware that you could ask a bank to fund your renovations on top of your purchase. So first few deals, money was tight because I wasn't raising enough reserves up front. And then I got into heavy renovations, which are expensive, and those were all coming out of cash flow. So those 3 deals, were tremendously successful. You know, we fumbled our way through them, and we had a great market to help us out. But all three of them, we ran into that same issue where we were just a little undercapitalized going in, and we didn't have that renovation budget to really finish off the business plan. Instead, we were kind of limping along over the course of a couple of years as opposed to just getting it done. So the big tactical thing I took away from jumping into those deals, getting up to 60 units, was going forward, we're going to have plenty of extra money at closing. And if we can finance our renovation budget, we're going to do that. And we're going to try to move through these renovations with speed, because I started to realize that execution risk is a huge thing in this value add game. If it takes you 2 years to turn a property around, that there's a lot of risk there. Whereas if you could do it in 6 months, you're significantly decreasing the amount of risk on that deal. So it was very clear to me after those three. You know, I made it through. We survived, never lost money. I still own a lot of them today. But it really flipped my mindset on how we do deals. And it was a big reason why I wanted to bring the team in house, was because I need to be able to do these business plans quite a bit faster and reduce the execution risk on these deals. And the big thing was just having more money available up front, which I think is a common mistake for new investors.
That's how I got punched in the mouth in the first few, and I think a lot of people just stumble into that because, well, one, it's tactically just hard to raise money forever. It never, it gets easier, but it's always still a challenge. It's always a constant grind. But then early on, especially, it's obviously harder. So you might close with a less money in the deal because you had a hard time raising more, and then it's the most misunderwrote expense in a deal is just what you're spending on renovations usually. You're almost always going over budget, especially with the early 1900s stuff that we're both familiar with, and that anyone who's doing deals in New England is familiar with. You're buying a bunch of 100-plus-year-old buildings, and it's very easy for something to get a little out of whack there. And it's easy to start running light on cash, especially if you're trying to make the distributions and you're trying to make your investors happy because you told them that you'd start your distributions a few months in or 6 months in. And it can be a really scary place to be. It can be a really compromising place to be, especially if you grow quickly and scale quickly, and that's a challenge across numerous deals. And it's also a challenge with folks who are just doing deals with their own money and they just are buying a lot of deals with their own capital. It's, you spread yourself thin. So being undercapitalized, I feel like, well, especially the last couple of years, it's been such a topic for a lot of folks doing deals outside of New England, which has been a really steady market, as we're both aware of. But that is such a big piece of advice, is just raise a little bit more upfront and just be less enthusiastic or optimistic about the outcome of a deal, and be okay with projecting lower returns. I think and this is a question I'm going to have for you, a lot of the people that were investing with you early on, I'm sure, was because of personal relationships, not because they thought that you were going to get an 18% IRR versus a 15, which is like the other deals they look at. The longer I'm raising money, the more I realize that investors they're not cherry picking over the specific IRR. They're like, do I trust this person? Do I like the deal? And do I think there's upside in the market? And that's usually how that starts to go. How you build that relationship initially, and then they're just writing checks based on those items, not because they really like that projected cash on cash return comparatively to something else. That can help inform a decision, but it's not going to be one of the first things that they're looking at. And if it is, they're probably pretty short-sighted. But to spin it back to your trajectory here, family and friends are probably coming in the beginning. Was there a point in time where you started to actively go out there and try to engage new investors, build relationships with new passive investors, in terms of, we got to start raising some more money? I want to start actively building these relationships so that we have more money available to go and fund new opportunities. And if so, what were some of the early steps you took there?
Yeah, absolutely. But just to back up real quick, I'm talking about undercapitalizing deals early on in your career. It's a mistake that everybody makes, but at the same time, the same side of the same coin is a different side of the same coin. You need to be very scrappy and need to have a high appetite for risk if you're going to try to build a portfolio organically like you and I have. There's going to be quite a few times where you are betting the farm and everything you have to get into a deal. And that is just the reality of building a portfolio the way that we have organically. It's not for the faint of heart in those early days. You need to be able to take on some risk, and that's okay. So don't let me say undercapitalizing deals is going to hold you back from buying a deal. You need to just go out there and make some stuff happen. There's going to be some moments when things are tight, and you got to just be able to operate through those moments. But going back to your question about getting out there and meeting new investors, Yeah, I mean, basically, my friends and family circle is not large. I don't come from a wealthy family. I didn't really know anybody growing up who I would consider as wealthy. I didn't know a lot of entrepreneurs. Basically, I knew lots of people who made a good living with their W-2, and that was it. So I don't have a big roster of investors. My friends and family group tapped out pretty quick after those 30 units. There's nobody with an unlimited bankroll here. So I, out of necessity, did have to go out there and start trying to just, find investors, which kind of brought me back to my mortgage days and had me feeling like I was in the sales job a little bit, but it's a necessary evil of the business. And a lot of that came organically for me. Um, Friends and acquaintances of other investors is typically the next step outside of that first circle. And then I now do quite a bit of cold outreach to potential investors and trying to just build that roster. But like you mentioned, my investors now, I'm quite certain that they're not very concerned with the returns. They're, like you said, they're more investing in me as an operator, and hoping that things will work out because they believe in me and my team. So that's really what it comes down to when you're raising money, especially in the early days. I'm not talking about when you're visiting family offices or anything like that, but when you're doing this relationship based money raising, they're investing in you. And I even had an investor tell me at breakfast the other day, he goes, I was talking about returns on a new deal that we're working on. And he goes, Sean, I'm not really that concerned with the returns. I'm having a lot of fun in this process. I think it's very cool how we're turning these properties around. And I just want to keep doing it. And that was a big realization for me that, it's not all about the spreadsheet. It really is about just relationships and them really believing in you. So.
Yeah. Yeah, I mean, especially early on, right? I mean, the first however many individual number of investors you have are just one. If you're dealing with people that are unsophisticated and don't come from this world, they're probably you'd start talking about IRRs and equity multiples, and their eyes glaze over, right? So it's like you kind of have to move the conversation away from that and simplify it for a lot of folks in general. I was just talking with an investor who's in a project that you and I are involved in. I'm going to share this story after we're done recording, um, but he's like, the deal has gone extremely well, almost, near 100% return of capital since we closed, or I think it was, 14, 15 months in. And he's just like, I don't even, what happens now? Like, all right, cool. I got it back. Like, so what does the next year look like? And there's like a total kind of break from the reality of the deal, but he came in just based on us having a long-term relationship and kind of knew it, felt comfortable that it would work out. And early on, those are going to be the folks that you're probably working with to capitalize a lot of your early deals. And it's more about the story of you knowing what you're doing and less about the actual numbers on an Excel spreadsheet. Not that stuff doesn't matter and you have to underwrite well and raise enough money and all that, but I think it's important to detach yourself. And I think this is the tactical tip for the listeners: detach yourself from the actual underwriting and attach yourself more to the story of why you've done, why this has worked out for you, what you've already done, why it probably makes sense for them if there's somebody who has this disposable cash to invest, and live there conversationally versus the financial kind of 101, because that's typically where you're going to have more challenges up front with at least some of the folks that are less sophisticated in my experience. And it seems like it's been yours as well. All that being said, so what comes next for you guys? Like, you caught 150 units, you've done a couple hundred. You're obviously talking about how you want to grow a larger enterprise. What are some of your short-term goals? And then where do you see this going longer term?
Absolutely. As far as specific short-term goals for the business, I see my business getting into the thousands of units. I think we can get there likely without having to leave our current markets, but that remains to be seen. And then more importantly, I want those units to be filled with extremely happy residents. And that means that I'm going to have to continue to hire amazing people on the management side and build out really good systems. And then long term, I mean, just talking big picture outside of the business, I think of this whole real estate and business thing as a game. And I absolutely love the game. I love to play it. I wake up every morning with a fire in my belly to go do deals and grow my business. And my real long-term goal is just to keep that fire burning as long as possible and keep playing the game, ideally for the rest of my life. So that's really what my long-term goal is. But short term, we're going to grow the business, and ideally, the long-term outcome for me is I'm old and gray. I have a sizable portfolio of quality assets. I have a robust management operation wrapped around it. And maybe I can convince one of my little girls to take the reins and keep the snowball rolling downhill, so to speak. But that'll be up to them at that point. And that's really it. I'm just enjoying the process. I had a realization a few years ago that, like, it's a game. I love the game. Let's just keep playing it as long as possible. And my focus is changed from trying to hit a hole in one on every hole to just, you have to keep it in the fairway. I'm a long-term investor. I'm going to be doing this for the rest of my life. My real goal is to stay out of trouble, stay out of those water hazards, stay out of those sand traps, and just keep it down the fairway. And if I do that, I'll have a pretty good score when it's all said and done. So,
Yeah, I mean, I resonate so well with that, or so significantly with that realization of, like, just hit doubles, hit singles and doubles. And if you hit a triple here and there, great. You're going to make everybody happy. But, if you were to take it to the logical opposite of that, the extreme opposite of that, where let's say you do a bad deal trying to swing for the fences and you lose 50% of your investors' money, right? That's a terrible outcome. Or your own money, you do a deal yourself. If you're listening, you're not raising money. You throw your own money at a deal and you lose half of it because it went sideways and it didn't go as you planned. If you lose 50% of your investment on a deal, the math is it takes 8 years at 7% to earn that back. 8 years at a 7% return. I mean, this is a game about not losing money, first, foremost, second, third, fourth, fifth, down to 10. And then we start talking about let's figure out how do we go make some money. Especially when you're trying to scale an investment platform where you're consistently going back to the same pool of investors to reinvest and to do more deals. The one tactical thing that I'm curious about asking you there, and you kind of touched on it, is, and I was going to ask you to probably close out the show, is the focus going to be on New Hampshire? At least as you see it, you're talking 1,000 units, or thousands of units. That's certainly possible in New Hampshire, right? I mean, we all know the management, or the investment companies in New Hampshire that own in the thousands of units. But have you ever had an interest in going outside of New Hampshire, or has it just been like, we got enough opportunity here, we're building a management company here, this is where our focus is going to remain?
yeah, great question. So, first of all, I feel very fortunate to have New Hampshire be my hometown market and be in my backyard. I think just the fundamentals of the market are extremely strong. And I'm very bullish on the area going forward. That's part of the reason why I like to stay in New Hampshire. Obviously, when you're buying smaller properties, which I still do in my personal portfolio, I'll still buy a duplex in my personal portfolio if it makes sense. Obviously, the management of those type of assets, much easier when there's physical proximity to the properties. So, you know, that's really the main reason, why that I went that direction. And I'm sorry, remind me of your question, Axel.
Well, I was just going to say, did you ever consider going out of state? Once people start to gain some momentum, I think there's a lot of folks that are like, they start to go look elsewhere. But
yes, I apologize. So, the other reason why I've stayed in New Hampshire is my main marketing, right? I'm not a huge direct to seller guy. I've done a lot of direct mail in my day. I've never been, consistent with it enough to have true deal flow out of it, but I understand the merits of it. I do some direct to seller, but my main form of what I would consider marketing is I am completely entrenched in my market. So we didn't touch on this yet. Well, I guess we did. Prior to jumping into real estate, I was in the mortgage business for 8 years. I was working with residential real estate agents day in and day out. My wife owns a settlement company, a title company in New Hampshire. She's ingrained in the real estate market in the state. And I just have a ton of relationships in this market. And a lot of my deals have flowed to me because of those relationships. And I know, as you know, that multifamily is a relationship game, and that buying a deal off the market, you have to make peace with the fact that a bunch of local investors already passed on that deal, right? So that was the big thing that kind of kept me in my lane in New Hampshire and made me think that it's going to take me years in another market to get to the point where I am now in New Hampshire, where I have the deal flow that I have. So I was a little discouraged by that. What I will say is that my mindset has opened up very recently. You and I are working on a deal now where there's on-site management in place, and just the planning of that deal and the way the operations will run with that on-site person in the mix has opened my mind to, this wouldn't be so different if we were doing this in North Carolina. This wouldn't be so different if we were doing this in Maryland, wherever it may be. So that has changed a bit. And I think that's why you see all these larger operators exclusively going after the 100+ unit assets, because they know they can have that on-site infrastructure. And that changes everything. When you have that one person or two-person people there to handle the things on site, and the management experience is much different. So I will say that I've come around to it. I'm open to it, but I'm a little afraid that I'm going to have to go in there and overpay for 3 or 4 deals to build some relationships to start getting good deals.
No, I mean, it's the shiny object syndrome is so real when you start to have some level of success or build some momentum in your backyard where you, it's easy to get like too big for your britches where you're like, let's go look over here. It can't be that much different. I know what I'm doing. I got all the, I know how to underwrite a deal and how to manage and how to operate and all that. But you're starting from scratch from a relationship standpoint, which makes it so much harder to find that deal, as you just described, right? It's every time you look in a new market, you're resetting all of the compounding nature of all the work you've done in your previous market to go develop your reputation and to learn the ins and outs of each street and submarket and neighborhood of each city or whatever that you're looking for deals. You're starting from scratch with the debts on the debt side, with the management company. If you're going the third party route, it's like it makes it so much harder to do that. That at least in my eyes, the people I've seen that have done it successfully, or as you mentioned, they're doing the on-site. They're buying deals that have on-site management. They get in there, they get a couple, and they have a couple of on-site folks, and their business isn't so fragile. But they're coming in with like so much backstory and history and experience executing that same type of deal that they come in with so much street cred, even though they haven't done a deal yet in that market. Which, frankly, a lot of the folks that are listening to this, and you, myself, like we're not at the point yet where we fit that mold. It's like if you own 2,000 units in your market and you're going to go start bidding on 50, 100 unit deals or whatever in another market, you could probably offer really competitive terms. You're sending over your balance sheet and your proof of funds, and it's like we're still out competing some of the local folks just by sheer mass of backstory and history and experience, which is really challenging to get to that point. Excuse me. But this has been great, man. And I really appreciate you kind of diving into the story. I think a lot of folks are going to take things away from the inflection point of bringing it in-house or bringing management in-house, going the third party route, trying to scale a little bit more quickly and a little bit, less incrementally and make those big jumps. In closing, I want to propose a scenario because I think there's a lot of people that are similar to your situation, which are maybe they're a real estate broker, maybe they're a mortgage broker, maybe they're a house flipper, maybe they're somebody in real estate, but they don't necessarily have a buy and hold portfolio. Or maybe they, similar to you have the duplex, et cetera. Where should they be spending their time first and foremost if they want to follow in the similar footsteps as you have as it relates to a little bit more rapidly growing a portfolio? Where do you think they should focus their time early on, or what do you think that they should be doing to put themselves in the best position to actually do something similar to what you've done?
Absolutely. I would say if you're starting from scratch and you have zero experience owning or managing real estate, your first step is to buy a piece of real estate. As simple as that sounds. For me, I wanted to learn things with my own money and learn things the hard way, and make some mistakes before I started bringing in investor capital. And I truly think that's probably the way to go about this business. So you don't know what you don't know, and I can tell you as a guy who went through 2 or 3 years of analysis paralysis of reading every single book and every single podcast that's out there, there's no way to learn the things that you learn when you own property and you own and manage property. There's no way that you can get that experience without having it firsthand. So you need to get some property, and what you'll realize, whether that's a single family, a duplex, a 4 unit, whatever it may be, your confidence will quickly expand, and you will have the confidence to take on the next property. And if you'll find out very quickly if it's not for you. For me, I was completely hooked after my second property. I knew I was going to do this for the rest of my life. That may not be you, but I would buy a small property and I would figure it out for myself. That would be my first step.
Yep. It's great advice. All right, Sean, this has been great, man. I appreciate the time.
Yeah, absolutely. Thank you for having me. Again, very much appreciate it. Huge fan of the show. So I look forward to keep working with you in the future.